Joining us now to discuss the impact of all this is CIO Group Chief Investment Strategist Stephen Wieting. Stephen, good to see you.
Thank you.
The markets, if you look at it top down, you would think maybe the strait weren't still closed and oil
Right.
wasn't at 100 and treasury yields haven't been leaking higher. It seems like AI has been the escape hatch for investors. Does it make sense?
Well, look, the AI trade, what's going on in software, hardware, this is really not dependent on the cyclical performance of the economy. These CapEx plans, whether they pan out well or not, they're funded, the bets are on the table, and you're going to see things move on that very independently from what's going on in consumer spending, travel spending, industrial activity, and especially Europe and Asia's, cyclical companies.
And by your lights, is the global economy really feeling the wear and tear of that just now in an observable way?
Increasingly. And the longer this stays shut, we're going to eventually hit binding constraints. I mean, it's one thing to pay for something, but, to move from here to there takes oil. It takes energy. And when you're going to have shortages, you're going to have that binding constraint come in. So I think what's happened here with oil for delivery out at the end of the year, moving $15 higher now, that curve pushing out the amount of time the straits are closed, the longer we have to take a look and say, we've got a larger problem for cyclicals around the world.
So what is your forecast for how do you view corporate earnings, let's say, that are more leveraged to a Europe or in Asia, areas that will actually feel the pinch much more directly than the United States from all these closures?
Well, it's ideally not the focus of our investments so much. Sure. But I would tell you they're the ones that will benefit when the straits open. And I guess as a day passes, we're going to get closer to that point. I think all it does take is an improvement in transportation for us to be, we could talk about damaged infrastructure, those sorts of things. But it's really binary. That, again, if we get through the supply shock, which is about transportation and storage, you'll see a lot lower energy prices and you'll see those things recover. But there's so much that's going on that's interesting right now. I mean, what's driving earnings? It's an expectation for an 88% gain in semiconductor EPS in the U.S. this year. And tomorrow, the four largest public company spenders on AI infrastructure are going to report and tell us a lot about what they're going to spend this year.
For sure. And it's almost as if, the S&P 500, let's say, was ideally constructed to withstand, the uncertainty about what the underlying economy might be doing. What do you think that means? I mean, the market's also been good with pricing out any Fed action, for the foreseeable at this point.
This is the thing. When you listen to Kevin Warsh talk about how bad things are at the Fed, and you wonder what monetary policy can really change the needle. Are we going to guarantee 2% inflation on a year-to-year pace every month? What are we going to do that's markedly different, that's really going to ensure that? Are we going to constrain the economy when there's a supply shock? It's kind of hard to imagine that it's going to be as different as all the talk. And I think that when we get through this, we're going to focus on the fact that the labor market is just insufficient. Every month it's higher or lower than expected, but consumers are saying that the path for employment and prices are unsatisfactory.
Are you bullish?
I'd say
bottom line.
I'm becoming a little more cautious about the way the Straits of Hormuz, this particular energy issue, is playing out. But there's still a lot to be concerned about here. We have a boom and a shock to deal with at the same time.
Right.
We could have said AI spending was booming a year ago, and we've talked to people who say, hey, worry about 28 and 29. So these companies, last time they reported, they increased full-year CapEx, just those four companies, by $94 billion. Let's see what they say tomorrow.
And some would argue that heavy CapEx plus the supply shock on energy, it all pushes in a direction of higher nominal growth, but more of it coming from inflation.
That's the unfortunate part of this. And I'd say that we're more interested, and we're already using an overweight in short-duration inflation-linked bonds as sort of the safe asset, and we're interested in more of that.